welcome to our weekly look ahead at the markets. Quick recap, obviously we had that shortened Thanksgiving holiday trading week that's just gone by, and it was a pretty sort of tepid week on many fronts, and the markets are drifting a little bit on the whole. We did see the dollar come off a touch, so sterling rose to 3-month high against the greenback. The euro also recovered that 200-day moving average. And we saw some stabilization also in the crypto space. We saw oil come off a bit, and then mixed reports from OPEC, and inventory data that came out showed a big big draw in inventories, but a big build in gasoline and distillates. So bit of a kind of sideways kind of feel about last week. I think a bit of a drift, partly because of the Thanksgiving holiday knocking out a day and a half of trading in the US. So all eyes now coming up on some key inflation and jobs data from the US. That inflation reading is the core PCE index. Remember, that is the Fed's preferred gauge of inflation, and that rose faster than expected, accelerated in the previous month to 0.5% month over month. Now that's quite a surge. Also, it's this broadening of inflation pressures, and also that focus on services inflation, which is traditionally seen as being stickier than goods inflation, which is at the mercy of commodity price fluctuations and so on. So we had that core PCE number a month ago. Since then, we've had weaker PPI numbers, and we've also had that weaker CPI number. Now that was the thing that kick-started the rally, that saw the market advance. So we're looking to see how this inflation narrative plays out this week against expectations for the Federal Reserve coming up in the middle of December. It's now expected to raise rates by 0.5%, or 50 basis points, not the 75 basis points that markets had slightly been pricing in and been looking towards that level. We have had some hawkish commentary from certain members of the FOMC, but also the minutes from the FOMC last week showed that most members believe that a slowing down in the pace of interest rate hikes, it will be warranted soon. So we think maybe that means 50 basis points in December. But this inflation reading will be important because it could reveal that actual inflation is proving stickier than maybe the last couple of the other prints, the CPI and the PPI, had indicated. Meanwhile, on Friday's non-farm payrolls. That's obviously important because as long as the labour market remains solid, the Fed can keep on raising rates. Now, last time around, it was better than expected, around 261,000 jobs created. That's a slower pace maybe than we've seen over the last year, but it's been a breakneck speed of jobs increases over the last year. So still pretty strong, 261. Wages weren't as high as expected. They came down a touch, and so that was a sort of mixed report. But on the whole, as long as that labour market remains solid, the Fed has ample cover to keep on raising rates. So those are the two key reports. Feeding into that non-farm payrolls on Friday, though, before that we have the ADP number, and also JOLTS job openings. There are 11 million job vacancies in the US. Not the sort of labour market that you think is going to struggle. It's not a recessionary labour market, even if we are heading to real terms recession next year in the US. We're not quite sure what's going to pan out there, but certainly the labour market remains exceptionally tight, and that should provide ample cover for the Fed to keep on raising interest rates. Meanwhile, there's an OPEC meeting due up. Now, we had reports from the Wall Street Journal that the OPEC was considering increasing production, but that would seem to go against recent trends. And actually, with prices coming under pressure and still trading around that $80 mark, we think probably the chances are that OPEC actually cuts more. Saudi Arabia and Iraq on Friday saying that they are willing to do whatever is necessary to stabilise and smooth the market functioning. So that OPEC meeting is a live one, and we'll be keeping an eye on that one. Otherwise, it's US consumer confidence from the Conference Board. That's been trending at multi-year lows, and we'll look to see whether or not the consumer is able to show any kind of improvement in their outlook. That's important as well, because if consumers are improving their outlook, then maybe the US economy is not going to head for that hard landing, and that again allows the Fed to keep on raising rates, which it will be a continual drag on equity valuations as we head into the new year. Market positioning, though, is seemingly heavily on cash. So, investors loaded up on cash, and there is a bit of a I think sense that maybe investors are locked and loaded to run up the market into the Fed meeting, potentially beyond the Fed meeting, into that Santa rally that you traditionally get in December. So we'll look to see what happens on that front. That's it for now. Thanks for watching.